Within the context of property, plant, and equipment, one of the biggest differences between IFRS and US GAAP is that IFRS allows entities to choose one of two models for reporting on fixed assets for each class of property, plant, and equipment. Examples of the various classes include land and buildings, machinery, furniture and fixtures, and office equipment. The first model is the cost model, which is the same as US GAAP. The cost model carries assets at their historical cost less accumulated depreciation and any accumulated impairment losses. The second model is the revaluation model, which is not in US GAAP. The revaluation model is based on fair value. The revalued amount is defined as fair value at the date of evaluation, less any subsequent accumulated depreciation and any accumulated impairment losses. It can be used for property, plant, and equipment whose fair value can be measured reliably. Companies choose either model for a class of assets. Companies cannot pick which assets within a class they will revalue at fair value. All assets in the class must be stated at fair value. So, if a company owns a lot of property, the ongoing cost of appraisals, which are commonly conducted to determine fair value, must be weighed against the benefits of stating the assets at fair value. Practically speaking, companies might choose to revalue land and buildings, but not other classes such as machinery, furniture, and fixtures. The standards also state that revaluation must be done with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using fair value at the end of the reporting period. Another big difference between US GAAP and IFRS is the issue of componentization. US GAAP allows componentization, but it isn't required, and in fact, it's not widely used. In contrast, IFRS does require componentization. Componentization is a term commonly used when referring to the requirement in paragraph 43 of IAS 16. This paragraph states, each part of an item of property, plant, and equipment with a cost that is significant in relation to the total cost of the item shall be depreciated separately. For example, for aircraft, it may be appropriate to depreciate the engines over a different life than the airframe. Another example is a building. A building's significant components could be the heating and air conditioning systems, the roof, and the electrical system versus the core structure of the building itself. That being said, if components of the same item have similar lives and usage patterns, they may be grouped together for depreciation purposes. Once the significant portions of an asset have been identified and separated, the remaining parts are grouped and depreciated together. If these insignificant parts have different useful lives and expectations, then an approximation technique may be needed to depreciate them in a manner that is faithful to their consumption pattern or useful lives. So, which approximation technique is used? Well, generally speaking, IFRS gives accountants more freedom to exercise their own judgment than does US GAAP. So under IFRS, the approximation technique used is left up to the accountant's own discretion. US GAAP permits separate capitalization of such items, but doing so is not common and may not have been done in practice. For example, buildings are frequently capitalized as one asset and depreciated over 40 years using the straight-line method. For many entities, separating existing assets into components for the initial transition to IFRS will be an enormous undertaking that is complicated by several factors. For example, businesses with buildings that were capitalized 20 or 30 years ago may not have the records of the costs of individual structural components. Bottom line, you will likely need to look at the rules for componentization as you begin planning for your transition to IFRS.